So let's see here. We're going to talk about the bubble and what exactly that is. Darren, as I go find the article, do you want to kind of introduce it a bit?
Sure. So, what did we see this past week? Things ramped up a little bit. First off, the first trigger was interest rates ramping up. We ourselves had an escrow that was canceled, at least partially due to interest rate movement from an investor that just didn't make sense.
Yeah.
Um, that's the reality of a moving interest rate environment, particularly when it's moving to the north. So what followed that, what preceded that, a topic that's been on people's mind, but we definitely saw a flood of articles this past week about bubbles. Where's the market heading? What's happening? And we've been covering a lot of who's in the market, why they're in the market, factors that can impact the market. Will now seem like as good as ever because it presented itself in the articles we're reading about like comparing how does this market compare to the most recent bubble that did happen. Is it a concern? If so, why? Or if not, why not? So
Yeah.
that's kind of what we're covering today.
Well, that's the thing, right? Yeah, definitely the media has been talking about a bubble and a crash and all these things. And I think they gloss over a lot of things. I'm sure there are many who hope this happens, buyers and others who've been predicting this for the last 10, 15 years. But we're going to get into it a little bit and let's decipher it and see what's really going on. So this comes from a motley fool service called The Ascent over at fool.com. And this is really kind of the signs that a housing market crash is coming. So again, entitled 4 Signs That a Housing Market Crash is Coming. Key points: anyone who claims to know exactly when the real estate bubble will burst is not being honest. Very true. The theory of supply and demand teaches us that once prices are too high, buyers will exit the market. At this point, it's impossible to check the news without reading that the housing market is about to crash. Oh, wait, the next news story says it's not likely to happen in 2022. The truth is this: no one knows for certain what's going to happen next in the housing market. The best we can do is look for signs. A crash or a popping bubble. Many people believe we are currently in a real estate bubble. One might define a real estate bubble as a period during which the following is true. There is greater demand for homes than the supply of homes on the market. Check. There is an unusual spike in the prices of homes. Check. More investors than average enter the market, hoping to flip houses and make a quick profit. Check. Buyers are willing to waive contingencies designed to protect their financial interests, like home inspections and appraisals. Check. As of this writing, home sellers are still in the driver's seat in most markets. Still, when you notice the following 4 things happen regularly, it's safe to believe a housing correction is not far behind. So what they've got here is number 1, home prices soften. Granted, home prices continue to soar in most markets, but there are definite signs of softening in some areas. For example, home prices in Peoria, Illinois are down 1.8%. And in Gulfport, Mississippi, they're down nearly 5%. Beaumont, Texas has experienced an overall drop of around 1.4%, while Kansas City, Missouri prices are down 0.7%. It's not much at the moment, but it's a start and worth keeping an eye on. Yep. What are the prices of those homes in Peoria, Illinois?
I don't know.
Number 2, inventory picks up. The true culprit when it comes to the current state of housing in the U.S. can be traced back to supply and demand. Supply and demand boils down to this: the less there is of something the consumers want, the more they're willing to pay for it. In the case of homes, the more they want it, the larger mortgage they're willing to take out. Back in 2020, when the U.S. began sheltering in place due to the pandemic, the initial school of thought was that sheltering would prevent people from buying homes. Instead, the opposite occurred. The housing market boomed as millennial buyers took advantage of lower rates, historic lower rates, to purchase their first homes. In fact, so many people wanted to buy property that the relative few on the market were snapped up amid bidding wars and shockingly high prices. As builders complete more new homes and the number of people selling their property increases, the uptick in supply can signal lower prices on the horizon. Once buyers are no longer caught up in bidding wars, cooler heads and prices will prevail. Number 3, confidence declines. February Fannie Mae survey found that 70% of people consider now a bad time to buy a house. There is some old-fashioned reasoning behind this result. Only 43% of respondents expect home prices to increase over the next 12 months, while 58% expect mortgage rates to go up. Plus, 17% of those surveyed say they're concerned about losing their jobs. People who are concerned about the future are less likely to get into a bidding war over a house. Number 4, rise in interest rates. Mortgage rates recently topped 4%. When was this written? While 4% is still remarkably low, rates are moving up, back to the theory of supply and demand. Eventually, high prices plus higher interest rates will reach a point that causes people to pull out of the market, softening home values. Given the number of experts claiming to know precisely when the housing bubble will burst, the old adage, even a blind squirrel finds a nut once in a while, is fitting. After all, by sheer chance, some of them are bound to be right. So there you go.
So if you stick with one topic and don't change your mind, you will be right at some point. That's guaranteed. Okay. So for those of you who've been on this bandwagon for a long time, you're going to be right. I don't know if it's tomorrow or next year, but at some point you will be right. So don't shift now. That's my suggestion to you. A couple things to digest there. Yes, we got up into the mid fours for sure. Which was kind of scary this past week. I mean, it's the highest they've been. I think the article I read was in 4 years. It's the highest rates we've seen.
Yep.
Supply and demand is still there, even though there might be fewer people who think there's a positive side to the market. I will say there are enough people to more than consume all of the inventory. So maybe those, I think it was the other 58% aren't rushing out to put their house on the market. Even if they don't think prices are going up, they're not trying to sell their house to then capture that. I think what the bubble even taught us, the bubble of 14 years ago, was that prices do recover eventually. And that for those who just kind of bailed on the market, it was a tough time, but those prices have obviously come back and well exceeded those numbers. So just like not owning a home, if you do own a home, probably isn't a great option. Okay. And if you have a long-term outlook on a purchase, yes, it's possible you might be buying at a more elevated moment. Possibility exists. Again,
right.
No one can confirm that one way or the other. But if you have a long-term perspective, most likely you're going to do just fine with housing and all the tax benefits that come along with it.
Right. So in answer to that first article, Darren, you pulled out this one. This is from calculatedrisk.substack.com. And it's trying to compare and contrast what this bubble is now versus our most recent memory, which is what you talked about there 14 years ago. Housing. Don't compare the current housing boom to the bubble and bust. Look instead at the 1978 to 1982 period for lessons. So let me skip through this. It is natural to compare the current housing boom to the mid-aughts housing bubble. The bubble and subsequent bust are part of our collective memories, and graphs of nominal house prices and price to rent ratios look eerily similar to the housing bubble. However, there are significant differences. First, lending has been reasonably solid during the current boom, whereas in the mid-00s, underwriting standards were almost non-existent. Fog a mirror, get a loan. And demographics are much more favorable today than in the mid-00s. All right, compared to the 1978 to 1982 period instead. A much more similar period to today is the late 70s and early 80s. Housing prices were increasing sharply. Demographics were very favorable for home buying as the baby boomers moved into the first-time home buying age group, similar to the millennials now. And inflation picked up from an already elevated level due to the second oil embargo in 1979, followed by the Iran-Iraq war in 1980, driving up costs. Okay. In 79, the Volcker Fed responded by raising rates, and combined with inflation, this pushed up mortgage rates sharply. Now the Powell Fed is embarking on a tightening cycle, and mortgage rates have already increased significantly. For review, here's a graph of expenditures on energy goods and services as a percent of total personal consumption expenditures through February 2022. So I think we can skip over this. Go ahead.
And I think the primary component of that, the article already addressed. There's definitely more details in here and good things to chat about, but it is an inflationary environment. And there is the demographics are that there's just a huge supplies or demand side as there was then. And obviously, if you play that out, there was a big bump in the late 80s where rates got super high, 17, 18%. But yet again, by the late 90s, and that's a decade later, prices had fully recovered. And during that whole 10-year period, even if someone didn't have all the equity they want in their house or didn't gain the appreciation, they still acquired all the tax benefits of home ownership during that time while having a place to live. And while rents rise, your mortgage payment did not change. Um, all the benefits of being in housing.
So by the time he gets through all these graphs, he writes, what does this suggest for housing now? Some of the factors are different today. Inflation was much more embedded in 1979 than today, and the oil shock exacerbated that situation. That meant heavy lifting for the Volcker Fed, and I believe for sale inventory today, especially for existing homes, is much lower than in 1979. Unfortunately, I do not have the existing home inventory data for that period. However, we should expect something similar to what happened in the late 70s. A decline in real house prices seems likely, and I also expect some decline in housing starts and new home sales. With solid lending, the nominal prices should be sticky downwards, and I don't expect national declines in nominal prices. The size of the declines in new home sales and housing starts will depend on how much inflation is embedded, and therefore how much the Fed will have to raise rates and reduce their balance sheet to control inflation. If a large portion of inflation is transitory, the impact on housing will be minimal. However, if the Fed has to raise rates significantly, then we would expect a larger impact. Currently, we have just to watch and wait. However, we can be fairly confident that we won't see cascading nominal price declines like during the housing bust, since there will be few distressed sales. I will write much more on why we should be looking to the late 70s period for lessons as opposed to the housing bubble. Okay, so to be continued again.
Right. Good article.
Yeah. So some slippage, but it'll be far more stable, is what it's saying.
Right. Basically. And the first article talked about some locations that don't relate to us. They're certainly not big, huge cities that we're in. But I will say this: if there's something I learned, that there are components to watch for, and even those singular components aren't absolutes. But you'll see things like the building, the building will slow. New homes will slow before resale will slow. But those people are heavily engaged, high volume risk compared to the individual seller and buyer. And they have a tendency to be more conservative and pull back first. So you're watching new home sales. Those are still moving forward, at least in the city we're in. The other component where people might pull back a little sooner in the past, maybe some of the shifts in working dynamics will adjust this, but it typically slows down in the suburbs before it does in the city. And we serve city and a little bit of suburbs, but watch those trends as well. The city.
Well, I know one thing that you talk about, and it's a similar effect, but yeah, right. If you look towards the valley, more suburban, you might see early signs there.
Early signs.
Even here in LA. So.
Yeah. But the question is, this is a new phenomenon we're dealing with that historically nobody has ever dealt with. The work from home dynamic, is that really taking hold? That's had an impact in the last 2 years because of COVID on the pricing in those suburban communities and rural communities. It's moved them up at an even higher rate than inner cities. So historically, that's what's happened. So it's worth watching, but I'd be curious to see if that trend holds true in this cycle.
Yeah. And as you're saying, back to history again, there's a part of the world that's in a big war, and we have no idea where that's going to go.
Well, that last article was talking about oil and inflation. I mean, we're dealing with both of those components right now, and nobody knows exactly where they're going to end up, but they're both on the table.
Right. It's funny. We've been working with a client that's looking in Palm Springs, and some of the conversations I've had with agents out there in Palm Springs, at least to give some signs of what you're talking about in terms of work from home. There was an agent who most of his business is referral because he was like 18 years in San Francisco and he decided to downshift, change his own life, move to Palm Springs with his partner. But he said that's all his business and he's busy and they're moving and they're working definitely far from their usual home.
Right.
And a lot of Los Angeles people, again, are in Palm Springs. So
Right. And the client you're talking about, it's a similar dynamic. Why do I need to be in the city and pay so much? If I can be close enough and come into the city when I need to.
Yeah.
That's real.